So my name's Liz Murley and I'm a lifetime mortgage specialist, or what you would know as equity release. I've been in financial services over 40 years and came to this sort of sector fairly late in life myself. I retired from my own main career. So what can I do to keep myself occupied? So I've been doing this type of advising for 10 years now. I love the conversation. I love the people that I meet. And it's primarily, same with you, about helping people meet their goals in later life, if you like, by accessing their property wealth. I very often see people 3 or 4 times face to face. This is a very considered decision. It's not a rushed decision. Unless there's a compelling reason to do it quickly, I like to slow it down, give people time to think about it, talk to their family, which is very important, because it did have a poor reputation in the past, and a lot of that came from families finding out when parents had passed away that their parents had done equity release and not informed them, if you like. So we very much encourage the involvement of the family in the decisions now, either via being present at the meeting or via Zooms or emails or those types of things. So that's me. So now the descriptor is a lifetime mortgage, which I think fits nicer with your sort of money coach language and things like that. But you're using a lifetime mortgage to release equity in your property. So we try and not talk about equity release if we can, because that's where the poor reputation was many years ago. It wasn't regulated. You didn't have to have advice. The rates were high. You didn't need to involve your family and all of those types of things. So the product has now really changed its coat, if you like, and now become a very good product that I'm very proud of. We now have a trade body called the Equity Release Council. I was a standard board member there for 5 years, and they are very strict standards that anybody in this sector have to adhere to. And a lot of consumer protections now to make the product a much better outcome for clients.
So 2 points on that. One is that my understanding is that now the rules are in place that an individual cannot lose their house. No matter what happens.
Exactly.
So, and that happened back in the 80s, but the perception's still there with some people.
And that's the biggest part of the job, is overcoming the myths and perceptions of the past, because we remember bad things, we don't tend to remember good things. So if I run through the main protection features, if that would help. So every provider and advisor like myself has to offer what they call a no negative equity guarantee. But what that really means is there would never be a chance where a beneficiary would be asked to pay any shortfall if mum or dad pass away and go into care and the property doesn't cover the outstanding balance. So that's one of the biggest sort of protection features. The loan is designed to run until the second person dies or goes into long-term care. But there's a new protection feature where on first death or the first entry to long-term care, the survivor can choose to pay up their lifetime mortgage if they want to without any penalty. So we call that the compassionate window clause. Basically, it's a recognition that you've had a major life event that you probably hadn't planned for and you want to be able to get out of the contract. All plans are portable, and what that really means is if you really want to move home, you're not stuck in your home, you can transfer your lifetime mortgage to another property. And one of the biggest things that I was personally involved in is now all plans and all providers allow you to pay the interest if you want to on a voluntary basis. So in the past, why it had a poor reputation is the interest was added to the balance. So you were paying interest on interest. So the loan would grow quite quickly in that regard. Now, if you have income, you can pay some of the interest, all of the interest, more of the interest, stop and start it, restart it at any time. So there's now flexible voluntary payments that allow clients to perhaps pay the interest while they're still working and then turn the tap off and not pay the interest when they fully retire.
So that is gold dust.
Absolutely.
And people need to know that. To dispel all of the bad perceptions or the current, or some people's perceptions of that these are a bad thing, selling the family silver, kicking a problem can down the road, that none of that is actually an issue. So that's really, really important. So thank you for sharing that. One of the strengths of equity release is that mum and dad live in their home, which they've curated and built and become very comfortable in for a long, long time, don't want to move to a 2-bedroom apartment, what do they do with all their furniture and all those sort of issues? This enables them to stay in their home, which at the end of the day is in most cases big enough to entertain their family when they come to visit, and also help their families along the property ladder, whether it be their children or their grandchildren. So, I mean, I see that a lot as well, and I spend a lot of my time with the cash flow modelling, showing how they can afford to help their family members without necessarily impacting their own standard of living.
Yeah.
But that's where the equity, that's where the lifetime mortgages is a habitual thing. I need to learn that. And maybe even in my own mind, sort of realigning the language to releasing equity, because that's what I'm talking about as the bigger picture, either through a lifetime mortgage or through downsizing.
Yeah, I mean, downsizing is the purest form of equity release.
Yes.
But today with stamp duty, cost of moving, particularly in this part of the world, people don't want to downsize, and actually if you go sideways from a house to a bungalow or a flat, you're going to pay almost exactly the same amount of money. So that release of equity is not as effective as it could be. And very often, and this comes up quite a lot again in Dorset, is the families say, oh, I don't want mum and dad to downsize, we like this property, we want it when they pass away. So the good news is the lender on death and long-term care entry doesn't care where their loan is repaid from. So if the children want to retain that property, they can. They just have to find a way of paying off the capital themselves. So if they want a second home by the seaside in Dorset, they just do a remortgage themselves or something like that. So the lender has no ownership of the property. It's just a mortgage.
Well, that's a really important point. And again, I think a bit of a misconception. The lender has no ownership of the property.
Yeah, and that's a very powerful statement that I make. You remain the owner of the property and the equity in it.
And that's for a lot of people why they don't want to move. They don't want to entertain moving. And I think another point that you made that was really interesting is the portability. So sometimes people want or need to move for valid reasons. They live a little bit too far away from the doctor's surgery and from the local shop, and bus routes are closing and bank branches are closing and all of those issues. So they could take out equity release and then port that to a new property if they do decide to move halfway through their sort of later life process.
I mean, I was on a call yesterday with one of the lenders, and porting is growing hugely.
Okay.
Which was a bit insightful because it's a benefit and it's a protection feature, but it was insightful to know that people are taking the lender up on it. So there is more porting. I think people's lives change, particularly on the death of the first borrower, if you like. Somebody might want to go live near their grandchildren, or they might want to move to Cornwall or whatever. So porting is on the
move
rise
towards their grandchildren or move away.
Whatever, So, I mean, I sometimes say to clients now, I can't think of a reason or a scenario that we can't cater for. There's another protection feature called a downsizing guarantee, which is yet the final scenario, if you like. So with most lenders, if you've had the plan for 5 years and you won't want to downsize to something that they wouldn't consider lending on, so they won't allow you to transfer it. And I always use a mobile home as an example, because that's obviously not bricks and mortar. Property in Spain, they won't transfer the mortgage to something in Spain. Something of very unique construction that they won't lend on, something like here where you're on the riverbank and it can't be done, then they will allow you to pay the mortgage off without penalty if they will not lend on the property.
The interest rates on lifetime mortgages are fixed.
They are.
Okay, so that risk is just completely wiped off the table.
De-risk the variability.
Yes.
But at the moment, and also what's happened in recent times is rates are more aligned to normal rates, where in the past there was quite a big difference, if you like. But now, say for example, at the moment, the best rate I've got is about 6%. Well, in the normal market, rates for 4 or 5 years are about 5%. So that difference has gone away. But the other good thing is if you want to refinance or remortgage, so say if rates did fall, and I usually say to clients at the moment, you'd want them to fall by half, then we can refinance it to a better rate.
Right.
So you're not stuck forever. You'd have to pay some early penalties, but I would work out that it was worthwhile doing so.
Or not, in which case you stay.
Yeah, but if it's not,
okay.
If it's
So
not financially viable,
that's really interesting as well. I wasn't aware of that.
Yeah.
And that's the thing here. I don't sell or recommend these products.
Yeah.
I signpost to experts.
Yeah.
For reasons like that you've explained, already, things that are like, oh, okay, I wasn't aware of that.
Yeah.
Why would I be? Because it's not a market that I operate in. It's a very, very good option if the alternative is that you do not fulfill the ambitions and the life that you want to lead. Yeah. Why are you not going on those holidays that you've always wanted to do when you could afford it? And this is a way of affording it.
Yeah.
And the alternative is that you don't do this and you carry on living in this nice big house. Big houses need a lot of work, a lot of cleaning, a lot of maintenance, a lot of cost.
Yeah.
That you then can't afford to go on the holidays and the trips, or spending money on your going out for lunches or whatever it might be with your family and your loved ones. So this is a really positive alternative to that.
Well, I think in the past, promotional things that were done on the TV, if you like, about equity release showed beautiful couples buying a yacht and dancing off into the sunset.
Yeah.
I promise you I've not done a single case for that.
Yeah.
So it's always needs-based, always a solution, very often a family solution.
Yeah.
And there are nice things that you do, of course, camper vans and things like that, but generally you're either helping them create more wealth or income because they've undersaved for their pension. You're protecting the pension because why would you touch that lump sum, because that was there for income and it's tax efficient to leave it where it is. You're helping children with all manner of things. A growing thing now is adapting properties to stay at home for long-term care. Wet rooms, extra bathrooms if you want a live-in carer, that type of thing. Paying off existing mortgages. So a lot of people, you will remember, cashed in their endowments and didn't make a plan to pay off the capital. So that's probably 20-25% of what I do.
And there's a large number, I don't know what the percentages are, of people with interest-only mortgages coming to the end of their fixed rates. This must be a really good positive option to that.
Made no plans to pay off their repayment mortgage with an existing bank. Actually, it was an interest-only mortgage. And the bank will not extend because mainstream banks have different rules and regulations, and they have no choice. So they're almost coming to me saying, "Please help me stay in this property." They know they've made a mistake. They should have done something about it years ago, but that's human nature, isn't it?
Yeah, but we are where we are. And there is a solution.
So I've written to them already and said, do not worry, I can, within the figures that you've given me, I will be able to remortgage to a lifetime mortgage. You can stay in your home. And what a relief that was to them.
And I think that's another thing. It's like this is a solution to a lot of problems, and that staying in the home at a time when that must be incredibly stressful for them, expecting to have to sell the property to clear the debt, and then they're looking at what's left and starting to look and see what sort of property they're going to be able to get with. That's a massive disruption to their life. They're moving from a 2 or 3 bedroom house into a 1 bedroom apartment, for example, 10 years before they were expecting that might ever be something they would have to consider. Well, that's pretty soul destroying. Whereas this is a valid and viable alternative to doing that. So that's a really positive thing.
I think if people are still pre-retirement, so still working, because I see a lot, I'm sure you do as well, I see a lot of people 55 plus who perhaps have left their main career doing something else, but they have not got their state pension yet. It's that gap where they've still got normal debts and mortgages that they haven't quite planned. Or health is another big thing that comes along and takes people's legs off, doesn't it? I hadn't planned for that. So
that can come out of nowhere. And I think where I see it as well is where you've got with the graphs that my cash flow provide, where you've got those 3 scenarios: more than enough, nowhere near enough, to having enough. If when I'm doing those charts, if I factor in having nowhere near enough, that might be, I was doing an example case yesterday where that actually meant on a chart, it's difficult to replicate on a video and all the rest of it, but on the charts that I use, that might be money to a 60-year-old, that's money running out at 75. don't go ahead on that basis. That's not a good strategy, because you don't know when you're going to die. If we knew when we were going to die, wouldn't, financially
make our life a lot easier.
Be a lot easier. But so, that's not a good strategy. But if in 10 years' time we factor into those charts that you will strongly consider, or you actually do, to a lifetime mortgage, for example, that's what gets you from there to there. Now, the real significance, i.e. you're never running out of money, and actually, having enough to leave a legacy to your children, that's a massive difference. But if that means that you can retire on the 1st of January, that's the difference. And it's not kicking the can down the road in terms of, we'll just bury our head in the sands and we'll make it's like that's the scenario is based upon those assumptions. And yes, you are going to do equity release in 10 years' time, but that's what's going to enable you to take real action tomorrow, which might be, by the way, retiring on the 1st of January and giving you the income that you want, which you've factored in is enough for you to maybe make some gifts to children, or certainly start planning those holidays and what have you. And certainly a lot of the conversations I have with clients are around phased income in retirement. So if you're going to retire at 60, you are probably want and will spend more money between 60 and 75 than you will between 75 and 90. So that scenario lends itself very much to go and have your 5 or 10 years of travel and all the things that you want to do. But then maybe when that stops, then you could restart then paying the interest or some of the interest.
I mean, I call it the wellness years, and I've seen it with my own parents. In post-retirement, they had a great time.
Yeah.
From the age of 80 onwards, they didn't do anything. They just sat in a chair.
Yeah.
And actually, their savings went up.
Yeah.
Because they weren't spending any money.
Yeah.
Plus, they were getting attendance allowance and things like that
Yeah.
by then. So actually, my father died with money, which was kind of odd.
Yeah.
The other thing this product now...
But with amazing memories.
With good memories, yeah. Lifetime mortgages are the only product that you can have a lump sum and a drawdown, which fits quite nicely with your phased idea.
Yeah.
So you can have a lump sum up front and a facility to draw in life. So if you're not fixing a lump sum solution like gifting or whatever, we are going down the drawdown route all the time.
Yeah.
Because you only pay interest on what you've taken.
So you would have your facility to borrow, let's say
it's 100,000.
100,000.
20 up front, 10 grand a year until you stop travelling.
Or and stopping that if you don't need it. Yeah. It's the ability to take 10 grand a year.
If you never touch the facility, you've paid nothing for it.
Right.
So
again, the flexibility.
The only product in financial services that you can have a facility like that, tapping into your property well. And again, drawdown plans are increasing year on year.
Yeah. So a lot of what I do is about realising what your goals are. And sometimes I have to work quite hard with clients to get them to actually sit down and think about it, because why think about something that they don't believe is possible? Well, no, it is possible, and that's my job, is to sort of try and align their finances to their dreams. But I do spend time with them to work out what their dreams and their goals are. Yeah. What if scenarios, and then it's like, well, actually, you know that you could do that. So we are only here once. Yeah. It's madness not to do that. Yeah. So, and this is just a facility to enable people to do that. So I think it's a really powerful. And
if you access your facility, the drawdown is at the rate at the time, the prevailing rate. So let's imagine right now we're in a fairly high rate environment.
Okay.
But if you have your drawdown plan and you say you draw more money in 5 years' time, if rates have fallen, it will be at the lower rate.
Wow.
So you end up with a sort of blend of rates, which is much better for you in the long term.
Yeah.
There is no point, and I do say this to clients, drawing £100,000, putting it in the bank, waste of time.
No.
Unless you've got a need for £100,000.
Okay. So a facility for £100,000, you want to give a bit. You want a big holiday, £10,000. You want to give £5,000 to each of your children to top up their deposit for a property, or grandchildren, or whatever it might be, and you might need that £10,000 a year topping up your income because you've got some other holidays and weddings and so on to pay for. But then you don't need to take it if you don't need it, don't take it.
That's right. And that's the only product I can think of in all my 40 plus years that looks like this.
Yeah. But if you come from it at the from a place that I know that you do and I do, and in fact most people I deal with, and I can think of countless conversations that I've had in the last 24 hours with other advisors in different areas. We all come from it in the same place. What is the most beneficial for the client that is going to help them and have an impact on the way that they live their life? And that, as you've said rightly so, it's not all about just going off and going mad and booking loads of holidays and cruises. It's helping them just to live their life, pay their bills, and just have a nicer life, or help their family to navigate through what is a difficult time financially and economically.
And interestingly, a new thing for me in the last 12 months has been private healthcare. So people coming to me and saying, I can't wait for a new hip on the NHS. Can I borrow £10,000 to have a new hip? So I've probably done half a dozen cases in a basket of solutions, a basket of things that you're trying to achieve. I'm going to set aside money for a new hip, new knee, new shoulder, whatever it happens to be, because I don't want to wait in pain on the NHS waiting list.
So something that's just really sprung into my head, and whether this will work or not, and if it's valid, we'll leave it in, and if it's not, we'll cut it out. But it's almost like saying to someone, if you had £100,000,
what would you do with it?
You won £100,000 on the lottery, what would you do with it? And it's like, right, well, my wife really does need a new hip. The kids could do with a bit of a help. One of them's getting married next year. One of them's, just moving house. We'd like to give them a bit of money. I've had enough. I really want to sort of slow down now and stop working or whatever. So we'd revisit what that looks like. And part of that would be, we want to go on a really nice holiday. We've always wanted to go to Japan. Let's make that happen. And then let's take all the kids away. That sort of thing. It's almost like fantasizing around what you would do with £100,000. But if there's all of that good that comes out of that, and some nice things as well, that they're wants, not needs, but there's some needs in there as well. Well, why wouldn't you do that?
Well, it's kind of why not. But our role, because you've done my role, is to look at a client's total wealth, isn't it? And say, well, but this bit of wealth that you've got, that's going to deliver you an income in retirement. That's your pension wealth. You can take your tax-free cash by all means. But by doing so, you're actually reducing your income, aren't you, by doing that? You've got, I don't know, I'm going to say something like £20,000 in a tax-free savings account. Generally speaking, that's your emergency fund.
That's your safety
net. The car breaks down, I need a new washing machine or whatever. But they don't generally have money for the dreams, if you like. And that's where but they have property wealth. So that's where this comes into it.
So you can have the best of both worlds, but in a sensible, informed and viable way, rather than just borrowing 100 or putting 100. Well, you wouldn't put 100 grand on a credit card, but rather than just sort of I'll sod it. We're going to go to Japan. We've always wanted to do it, and we'll worry about that in the future, sort of thing. It's a more sensible, viable way of doing that.
Thankfully, and there's no plans to change this, you cannot buy a lifetime mortgage yourself online. And I would be dead against that anyway if that was. So you have to have advice from someone like me who's got the qualifications and experience. And I do sometimes say to people, no, it's not the right solution for you.
Because you review their circumstances, and you can say, well, actually, you've got money over there that you're not touching. You don't need £200,000 as a cash reserve.
No, that's right.
Have you thought about spending some of that?
And then come back and talk to me. And I'm very happy to just say to people, no, it's not appropriate right now.
But that's where my cash flow modelling comes in, because I'm having conversations all the time with clients about this, but it's not, you don't need to do it now. Because they might be 55 or 60, and it's like, in order for you to retire on the 1st of January next year, and then people's eyes light up. It's like, whoa, is that even possible? Yes, it is, but we have to factor in, your money's going to run out at 75, but if you do equity release at 70, your money will last forever.
One of the things you could do early in your process is check the property out with me.
Okay.
This is a property transaction for the lenders. It's the resaleability later on in life that the lenders worry about. Because it's quite unique. So if it's unique, it's fact they hate retirement homes for the same reason. So anything that's over 55 can only be lived in by somebody over 55. The lenders in my space don't like them.
Restricts
because
the
you're
resale.
restricting the market for resale.
So And again, coming back to your point, where the lender does not have any ownership of the property, but they have to sensibly keep an eye on, could that property be sold?
Yes.
Let's take it to its extreme circumstance when the purchaser or the borrower passes away, and then the children or the executors cannot sell that property. That causes a problem back to the lender.
So the lender gives all the beneficiaries 12 months post second death to sell the property. So the family are given quite a bit of time to make that decision, because the lender doesn't want to be reputationally seen as coming in and sort of disturbing them too much in a moment of distress and grief. So the family have 12 months to make the decision. But I know lenders will then start to get interested after 12. What are you doing? Who are you marketing it with? How many viewings have you had? That kind of thing. I mean, they're still charging interest, so you know.
Yeah, but they're keener to get the debt repaid. But interestingly, because I'm very aware of this from clients' situations. That's 6 months longer than the government give to pay the inheritance.
Yeah, that's right.
You know? So you know,
I mean, I've given you a little shopping list, so you could probably I can walk into a property straight away and go, nope.
Right.
Yeah, and I can.
Well, that's because you specialise.
Yes. I've been doing it so long. I drive around my area going, not that one.
I mean, there's been so many nuggets that I've not previously thought about, you know. So, but it doesn't change. Nothing has changed. I still think it's a very, very valid proposition and option for a client to consider. And the closer they get to making decisions around it, the more that they should look into it and have that conversation with you as the expert. Even if I can see that, even if it's something that they're not going to do for another 5 years.
And I would encourage you to refer them to me even if they're not ready, because my time is free. Nobody pays me any upfront costs. So I really
just
don't
a
mind
chat,
having a cup of tea,
get them in the system.
You know, sit them down, just answer all their questions, all their concerns.
But they might want to accelerate the process.
Well, they might. But
because it's like, well, actually, why are we waiting 5 years? Let's do it now and give some money away to the kids or the grandkids.
Because the only time I can absolutely guarantee it is when the lender of choice, or a couple of lenders I might have chosen, values the property, because it's an independent valuation that's paid for by the lender. So there's no upfront costs either to get to that point. And then I can say to clients, you've got your, you know, guarantee that it can be done.
So it's almost like in principle, this is what you could borrow.
Like, but remember, when you're talking to people, this, for the lender, it's a property transaction. They're not interested in Mr. and Mrs. Smith. You are, I am. They're only interested in the property.
Bricks and mortar, what's the value?
It's a balance sheet thing. They're offsetting their pension funds with a different asset class. That's it.
So I suppose that's where a realistic valuation on the property.
And I do say that to people as well. This is a valuation for mortgage purposes. So very often not what they would get the 3 estate agents telling them is what it's worth.
Interesting. But incredible. Really, really valuable conversation. So I can't thank you enough.
You're welcome.
It's been brilliant. Thank you.
Good.